Welcome back to Alt Finance. I'm Alan.
And I'm Sam, and today we're talking about a glittering obsession, gold. The price of gold's been pushing record highs, and everyone's asking, is this a bubble?
Yeah, but lately, the tone feels different. Central banks are buying, currencies are wobbling, and investors who once called gold old-fashioned are suddenly hedging their portfolios.
Right, and it raises this delicious question. Maybe gold's not the bubble at all. Maybe the real bubble is the money we've all been using, the paper, that are finally beginning to lose credibility.
So in today's episode, we'll look at why gold's price is rising, what history teaches us about bubbles, and whether fiat currencies, that's money backed by nothing but faith that the numbers on a screen still means something real.
Exactly. We're going to peel back layers of history, psychology, and economics to ask, what if the system itself is the bubble, not the metal?
And let's start with the obvious. Gold has been on its tear. In nominal terms, it's out on near record highs. Adjusted for inflation, it's still below its 1980 peak, but the trajectory is striking.
Yeah, what's interesting is who's buying. For decades, gold demand came from retail investors and a few emerging market savers, but now central banks are the ones leading the charge, especially in Asia and the Middle East.
Exactly. The People's Bank of China, the Reserve Bank of India, and the Central Bank of Turkey all have been accumulating gold steadily. Why? Diversification, but also mistrust. They're quietly saying, we're not sure that the dollar-dominated system will hold up.
And that's the subtle alarm bell. When institutions that print money start buying gold, it tells you they sense risk in other printed international reserve currency.
There's also the geopolitical angle. After Russia's reserves were frozen in 2022, other countries took notice. If our dollar assets can be switched off with a keystroke, they thought maybe we should hold something that can't be sanctioned.
Gold, of course, can't be switched off. It doesn't rely on SWIFT or trust in any one central bank. That's part of its timeless appeal.
Exactly. Then there's the inflation argument. Roughly 42% of all U.S. dollars in circulation were printed during COVID. The initial inflation surge has cooled, but the monetary base hasn't shrunk proportionally. That liquidity sits in the system like a loaded spring.
Exactly, and investors sense that. They're looking at debt to GDP ratios above 100%, persistent deficits, and they're thinking, maybe gold isn't soaring, maybe currencies are quickly deteriorating.
I love that framing because gold doesn't really rise. It just reveals how much paper money has fallen.
Right? The illusion flips. People say gold is expensive, but maybe the pound, the dollar, and the euro are just losing value faster than we admit.
But see, we should be honest. Markets do have manias, and gold isn't immune to them. Remember 2011? Everyone piled in, then it crashed for almost a decade.
True, every asset has its cycles. The psychology of bubbles is fascinating. Prices rise, people chase, narratives emerge to justify the rise. It's different this time, and then it collapses.
Tulips, tech stocks, housing, human nature repeats. But gold's story is slightly different, isn't it? It's not a company or technology. It doesn't produce earnings. Its value is psychological, historical, and monetary.
Yes, which means when confidence in paper systems falls, gold becomes the mirror. It reflects fear, but that doesn't automatically make it a bubble. It could be a rational repricing of trust.
I like that repricing of trust because money itself is a collective story. Well, a grant has value until we don't.
That's where the germ comes. Maybe the bubble isn't gold enthusiasm, but rather the blind confidence that fiat currencies will always maintain purchasing power.
Exactly. Think of the 1970s. After Nixon ended almost standard, inflation soared and gold started from like $35 to $800 by 1980. People called it a bubble, but looking back, it was revaluation. The market adjusting with a world where money was no longer anchored to anything tangible.
Damn, that was happening again. Only this time, the numbers are bigger, the debt's deeper, and the illusion more global.
Now, you're starting not forget. With 50 years of fiat experiment, every major currency is unbacked, all rely on debt creation to sustain growth. Historically, that doesn't end quietly.
Indeed. And when the average lifespan of a fiat currency is 30, 40 years, we're well past that for the current system. So if people start migrating towards hard assets, gold, silver, it might not be mania, it might be survival instinct.
Right. Let's dig deeper into that idea. The real bubble might be paper money.
Absolutely. Look, a bubble, in simple terms, is when the price of something detaches wildly from its underlying reality. Now, if a pound buys less each year, but we keep pretending its value is stable, isn't that the greatest detachment of all?
Inflation is slow erosion. It's the quiet bubble expanding under the surface. People don't feel it immediately because wages and prices move together until they don't.
Exactly, and because it's denominated in itself. We measure inflation in pound or dollar, so it hides its own decay.
It's like measuring the length of candle using another candle as a ruler.
A brilliant analogy, you're right. Fiat money's biggest trick is self-reference. Governments can print it, but they can't print trust.
And once that trust slaps, it's game over. We saw this in Weimar, Germany, Zimbabwe, Venezuela. At first, everyone says that can never happen here. But it already starts the same. Deficits fighting right for debt, asset inflation, and gradual loss of fee.
And here's the irony. People say gold is a barbarous relic, but the real relic might be believing in limitless debt without consequence.
Exactly. Look at government bonds, negative real yields for years. Investors willingly let money knowing they'd lose purchasing power. That's not rational bracing. That's bubble psychology.
And when that unwinds, gold looks like the sanity trade. It's not about getting rich. It's about not getting poor.
It's like financial seatbelt logic. No one expects to crash, though when it comes, you're glad you strapped in.
The other sign of fiat level is the constant need for more intervention. Every crisis, the solution is more money printing, quantitative easing, stimulate, rate cuts. The patient can't live without the drug.
Exactly. That's not stability. That's addiction. And as with any addiction, withdrawal gets harder each time.
So maybe what we're witnessing isn't a gold bubble inflating, but the fiat bubble deflating. We just looking at it from the wrong perspective.
It's like the gold just appears to rise because the measuring stick is shrinking.
And that's why long-term investors, not just traders, are quietly accumulating. They're not timing. They're hedging against the eventual reckoning.
All right, let's challenge ourselves, though. If gold's nearing record highs, isn't it fair to ask it, how sustainable is it?
Good points. On the surface, yes, gold looks pricey. But compared to what? You price gold against central bank balance sheets or against total global debt, it's arguably undervalued.
Exactly. In the 1980s, global debt to GDP was about 100%. Now it's over 300%. But gold's price hasn't tripled accordingly. If it were truly even pace, it would be far higher.
Also, the mining supply isn't expanding much. New discoveries are scarce, extraction costs are rising, and environmental regulations are tighter, so physical supply growth is limited.
Meanwhile, demands diversify. Central banks, ATFs for retail investors, and even fintech platforms are making gold more accessible.
So the fundamentals support it. But emotionally, people still treat gold as a relic, which is ironic because in every crisis, it's the one relic that works.
It's almost poetic. The barbarous relic outlaughed the modern financial architecture built on digits and promises.
Exactly. And if we step back, gold's stability isn't about price. It's about time. It's held purchasing power across empires, currencies, and ideologies. That's the ultimate anti-bubble record.
Yes, a Roman centurion could buy a fine tone governed Alta gold. Today, you can buy a fine suit. 2,000 years, same ratio. Try that with pound to dollars.
And that comparison always hits hard. It shows gold isn't volatile. Our systems are.
And maybe that's the heart of this whole debate. We're not witnessing a gold mania. We're witnessing a mining crisis in slow motion.
So where does that leave us? Is gold the bubble and the truth revealed by adversity?
Gleb, I say gold is the mirror, not the mania. The bubble is faith, and paper promises emperor outs how the faith erodes. Gold simply reflects the honesty of fear.
Beautifully said. Gold's price might fluctuate, but its purpose doesn't. It reminds us that value can't be printed, only earned. We're mines.
I think again, as we enter a new monetary era, one where gentler currencies, debt sequestration, and geopolitical tension collide, that reminder might be more valuable than ever.
So next time someone says gold is in a bubble, maybe the better question is, what is being measured against, and how stable is that?
Brilliant. On that note, that's all thrown us this week. I'm off finance.
We'll be back next time with another journey through markets, history, and the myths that bind them.
Until then, stay curious, stay skeptical, and maybe keep a little gold just in case.
Disclaimer. The content of this episode is for informational and educational purposes only. It does not constitute financial or investment advice. Always conduct your own research and due diligence before making any investment decisions.